Apple Computer reported their Q1 numbers today, and in my opinion, the iPhone maker left us with more questions than it did answers. And we'll talk about that on today's show. We'll talk about the Q1 numbers, take a look at the revenue. We'll take a look at the profit. We'll also take a look at Wall Street expectations, not just for the most recent 2 quarters, but going forward with Apple. We'll jump into these numbers, which on their face are absolutely fantastic. When you have over $100 billion in revenue and $33 billion of it flows down to net income, you know that's going to bring a smile to my face. We'll take a look at the profit and loss, the balance sheet, and the cash flows over at Apple. And then we'll come over here and look at this from a technical perspective as well. And what I said at the jump, Apple is leaving us with more questions than answers. And that is also going to apply to the technical chart pattern as well. I'll explain all of that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. We are pulling an all-nighter, doing recaps of the earnings season, and I wouldn't have it any other way. This is my favorite time of year and maybe one of my most favorite companies to cover, and that is Apple. Over the last year, shares of Apple are up about 29%. Year to date, though, off to a little bit of a rough start, down about 3%. I'm seeing in the after hours, who knows where this will stand tomorrow, but shares are down about 3% after being up about 1.3% during the regular trade. The revenue came in the most recent quarter at $119 billion. It was a fiscal Q1 for Apple, but obviously covered the all-important fourth quarter, which includes obviously a lot of holiday sales and sales of that recently released iPhone. They beat expectations by about $1.34 billion. Wall Street was expecting 118. They came in at 119. The high, what I like to look at is the high end estimate, because that's like your most bullish analyst on Wall Street. They were at 124. So the fact that Apple wasn't even really anywhere close to that, the low end was 116. They were actually closer to the low end than they were the high end. When you look forward with Apple, keep in mind, I know inflation has come down from where it was. We're still, though, in what I would call a semi-inflationary environment. The fact that this company is not really showing us a lot of top-line growth, and I know there's the law of kind of these large numbers. You have $80-90 billion in revenue, even just 4 or 5% growth there is significant, but we're looking at other companies like Amazon, which actually has more revenue than Apple. They're growing at a faster pace on that top line. Even like a Google and a Microsoft and certainly Meta, which we'll look at later today, these companies are growing significantly faster than Apple. And so that is one of the questions that I have. How is Apple going to reaccelerate this growth? I don't think it's going to come from the Vision Pro. While the device is like $4,000 after tax, I just don't think enough people are going to buy that. A successful device for Apple is one that your mom is going to buy. Most of us have moms. And rest in peace if your mom is not around, but your mom probably has an iPhone. Your mom might have an Apple Watch. Your mom might have an iPad. Do I see my mom strapping on the Vision Pro anytime soon, whether it's $4,000 or $400? I simply don't. And for Apple to move the needle, again, a near $3 trillion company with hundreds of billions of dollars in revenue for a whole year, that is the type of product that they have to release. Otherwise, you're not going to see a lot of growth. And speaking of not a lot of growth, look at your product sales over the last year, went from 96 to 96, up just fractionally. Your services revenue, which also another question that we have about Apple, there's that recent ruling that involved Epic Games that is going to allow game makers and a lot of app makers to allow payment processing outside of the Apple app tax, which is close to 30% in some cases. That should and potentially keep a lid on some of this services revenue, because I know if I'm a video game maker, I am incentivizing the buyer and whoever's paying to visit my website and sign up outside of Apple's 30% tax. So your total net sales over at Apple went from 117 up just fractionally to 119. First world problem, though, when you have $119 billion in sales and it's just a fractionally. What is very nice about Apple, just shows you their execution, is the fact that you drove down your product costs. Look at that. Despite relatively flat product sales, you did drive down the cost there, just squeezing the neck of those suppliers. That's why investing in an Apple supplier not always a great idea, because when their sales aren't going up, the way they squeeze out profit is just wring the neck from a revenue perspective. Services also ticked up in line more or less with your service growth. Your gross margins increased despite just marginally increasing your sales. You went from 50.3 all the way up to 54.9. Now, company also did a nice job on their other expenses. Their R&D essentially went down. Selling, general, administrative also just up fractionally. So your total operating expenses basically flat from 14.3 up to 14.5. So you have marginally improved sales, cost of sales that went down, operating expenses that went flat. Your operating income going to be positively impacted by that, up from 36 all the way up to $40.4 billion for a quarter, okay? $33 billion near $34 billion on that net income compares to about 30 the previous period. So again, just about 10% growth on that bottom line. Still obviously fantastic for a company of this size, even of this valuation. Now, moving over to the different segments that the company reports, you're seeing strong results out of every region except for China. I tell you what, they're feeling the heat there in China. I think there was some bans on from like Chinese officials or government officials, if you will, using the Apple devices. And so it definitely seems like that might be eating into sales to a certain degree. Now, more specifically is your product categories. Strong iPhone sales, I would say. Some people might not say that, but you went from 66 last year up to close to 70. But everything else, not so great. Your Macintosh sales basically flat. Your iPad sales really fell off the map. And your wearable sales, again, not a bunch of big refreshes on the earbuds or the other overhead headphones that they have. Other devices like the watch basically got banned from a sales perspective, at least on the high-end perspective. So that's not good. And your services revenue obviously ticking up. But again, another question mark there, how that recent lawsuit and legal decision will impact the services business going forward. From a cash perspective, we're not concerned at all. You got a boatload of cash up here in the most current period, over $73 billion. And then you've got this, you don't see this with any other company. They've got these marketable securities down here, are non-current asset. My guess is from a debt perspective, they have to hold these as a non-current asset. You got $100 billion in that. So you got about $170 billion in straight cash. You've obviously got receivables. You've got a small amount of inventory. That's what's always impressive about Apple. I don't want to make this like a bash on Apple, if you will. For a company with over $119 billion in net sales and to carry $6.5 billion in inventory is almost unbelievable. And maybe there's some accounting tricks to make that happen, but it's just incredible in my opinion. On the liability side, you do have a fair amount of debt that balances off in large part of most of that cash. But considering the cash flow, which we'll talk about here in a second, that's not something you really need to worry about. Net income, $34 billion, all your add backs and subtractions gets an Amazon-like, but this is the first time I think I've ever said this. You had about $40 billion in operating cash flow. That actually came underneath Amazon for the most recent quarter. So Amazon actually beating Apple in terms of operating cash flow in the all-important comparable quarter, which is very surprising. Now, what's different about Apple's business is they don't have to spend their money on anything. Purchase of property, plant, and equipment, just $2.4 billion. That's what like Amazon spends on a Sunday in terms of property, plant, and equipment. But they don't have to spend their money on anything. So what do? They have this massive $40 billion worth of operating cash flow. They barely spend any of it on property, plant, and equipment. So what do? They buy back the stock, $20 billion. And this is another question that you have about Apple, is that you're buying these shares, and sure, you can be negative on Apple shares, maybe outperforming the market. But the fact that they're buying back $20 billion worth of this stock every single quarter, it's tough for this stock to go down. Honestly, you have this big of a cushion underneath the stock. It's hard for the stock to go down. And on top of that, they've been doing this $20 billion buyback. I mean, they did it last year too, and they've been doing it for a while. And so you're just retiring a massive amount of shares. And so there's just less of these shares out there to be sold. Now, I told you there were some questions from a technical perspective as well. Now, from just a pure technical perspective, you are buying Apple at the open tomorrow because you made a low down here in January, you made another low here in October, and now here you are retesting more or less the all-time highs that we made back in December of 2021, but we should find some footing here with Apple at about $180 per share, and we should rebound to a new high. But what is not convincing is really the higher highs more recently could be described as a double top pattern, which if that's the case, you're probably heading much lower, probably south of about $160 on this one. That is where I would get relatively excited about Apple, considering the growth rate isn't as high as the other Magnificent Seven stocks. When you're looking at Google, when you're looking at Amazon, when you're looking at Microsoft, certainly Meta, even Netflix, obviously Nvidia, which is just growing at gangbuster speeds. Apple is bringing up the rear as it comes to revenue growth. So in my opinion, you want to get this one at the cheapest valuation, because in terms of outperformance, because that's what you're buying a stock today for. You're buying Apple because you think it's certainly going to do better than the SPY or the QQQ. You can buy these index funds and outperform Apple, both on an absolute and a total return perspective. Instead of taking single stock risk, I can buy the entire QQQ, or I can just buy the NASDAQ 100. Not necessarily saying you do that, but in terms of Apple, my confidence level that Apple outperforms and has enough positive catalyst behind it to outperform just the broader QQQ, or certainly other tech stocks that we regularly talk about here on the channel, is really, really low. I am not confident that Apple has enough positive catalysts behind it. I am not confident that we reaccelerate these revenues. Certainly if the company does, I will be proven wrong. But right now, I don't see any product in the pipeline. I also don't think the services business is going to grow at gangbuster speeds. I don't think the Apple Vision Pro, while it's a very interesting device and very cool, I don't think it's going to be mainstream and widespread from a buying perspective. Apple's going to be a low single-digit grower. They're going to buy back the shares. The stock is going to perform relatively well, but if you're looking for outperformance, I think there's going to be better options for you. Hopefully you guys enjoyed today's video. We'll be back again soon for more. Good luck with your investment.